Welcome back to the Pro Ticker Podcast, your Wednesday morning edition covering major financial magazine headlines, everyone. Today, we're diving into an incredibly rich collection of recent market reports and financial news you've brought us. We're covering everything from, well, staggering tech surges and the delicate dance of global trade, right through to the Federal Reserve's next pivotal moves.
Absolutely. And this deep dive, it's really crafted to extract the most important nuggets, the key knowledge and insights from sources like CNBC, Reuters, Bloomberg, Yahoo Finance, all pretty much hot off the press this week. Our mission is basically to help you cut through that information overload and really grasp the significant shifts and maybe some surprising facts shaping today's economic landscape.
That's right. And I have to say, one story really jumped out at me straight away from the tech world. Oracle's latest earnings. What did you make of the analyst reactions to that? Because according to CNBC, analysts like John DiFucci from Guggenheim, Derek Wood from TD Cowen, Brad Zelnick of Deutsche Bank, they were using words like slack-jawed, blown away, in shock, in a very good way. I mean, those are incredibly strong words for any earnings call.
They certainly are. And what's particularly fascinating here is why this reaction, especially since Oracle actually reported an earnings and revenue miss. The market's laser focus, as CNBC highlighted, was singularly on Oracle's forward-looking numbers. It really underscores how much investors are now, betting on future potential. Oracle stock soared 28% after hours, poised for its biggest single-session surge since, the dot-com boom of 1999?
Yeah, it's incredible. And the projected numbers are truly staggering. Oracle now forecasts their cloud infrastructure revenue climbing from $18 billion this fiscal year to an incredible $144 billion over the next 4 years. That's basically a tenfold increase in just 5 years. By 2030, and get this, their remaining performance obligations, that's a measure of contracted revenue, it soared to $455 billion, up an incredible 359% from a year earlier. I mean, to put that in perspective, that's just a massive locked-in backlog of committed future business. It provides unprecedented revenue visibility and, stability for the company.
Right. When we connect this to the broader tech landscape, this massive growth trajectory, it's largely thanks to their booming cloud infrastructure business and, a host of new artificial intelligence deals. CEO Safra Catz noted they signed 4 multi-billion-dollar contracts, including OpenAI agreeing to develop 4.5 gigawatts of U.S. data center capacity with Oracle.
4.5 gigawatts, it's huge.
It's a staggering amount of power, equivalent to several large power plants, just for AI processing. And what Oracle seems to be doing differently, compared to giants like Amazon, Microsoft, Google, it's focusing on unique technology, networking, and storage, rather than just, owning the data center buildings themselves.
That's a powerful differentiation strategy, but hang on, when an analyst like D.A. Davidson's Gil Luria says these aren't always organic customers to Oracle, but rather existing customers of Microsoft, Google, and Amazon just offloading their capacity, does that sort of temper the excitement, or does it hint at maybe a deeper, more complex shift in how companies are approaching cloud infrastructure?
I think it definitely points to a fascinating shift. This isn't just about Oracle, right? It's a powerful signal that specialized, high-performance cloud infrastructure, particularly for those demanding AI workloads, that's becoming the new battleground. It challenges the assumption that the big three will always dominate every single layer. It shows that even, legacy players can reemerge as market leaders by playing a differentiated game. It suggests a more fluid, maybe multi-cloud environment where specific expertise really wins out.
Okay, interesting. So from that intense competitive dynamic in cloud, let's pivot slightly. Let's talk about a different kind of market strategy companies are using: share buybacks. Jim Cramer, citing Goldman Sachs analyst David Kostin in a CNBC report, highlights that aggressive buybacks are currently giving some companies a crucial edge, especially as overall market buybacks have slowed down in the second half of the year.
Yeah, that's a key observation.
Yeah.
Buybacks, at their core, they basically drain the excess supply from the system. That eases potential supply and demand problems that can crop up from, say, a whole slew of IPOs. Kostin also noted that while buybacks slowed in the latter half of 2025, many companies are instead increasing capital expenditure.
Which is an interesting strategic pivot. It shows where that capital is being allocated instead.
Right. And Cramer even coined this term buyback aristocrats, stocks that have reduced their share counts by at least 1% in 9 of the past 10 years. He suggests these names, like Wells Fargo and Apple both buying back around 4% annually, they tend to outperform when the economy slows. To him, that signals strong management confidence.
It's interesting, though, to note this confidence in Apple comes even as the stock was actually down slightly after hours, fell 1.5% during the day, right after its big event showcasing new iPhones, AirPods, Apple Watches. That's according to CNBC.
Despite the new products.
Yeah, exactly. Yet its suppliers like Amphenol and Micron, they soared, hit new highs, up over 60% year-to-date. So this really highlights that a company's fundamental strategy, like those consistent buybacks, can sometimes outweigh the immediate buzz around product announcements in investor perception.
Okay, moving from the tech giants to something almost surprisingly under-the-radar Casey's General Stores, Jim Cramer, again on CNBC, calls it an absolute favorite under-the-radar growth stock with much more upside to come. What's the story here? It seems unusual.
Well, it's actually quite compelling. This Iowa-based chain operating mainly in the Midwest and South delivered a terrific quarter. Earnings and revenue beat, margin expansion, successful new store rollouts. Their deliberate strategy of targeting smaller markets, it's made them a spectacular regional to national growth story. It's almost like Casey's figured out the secret sauce hiding in plain sight, proving you don't always need flashy Silicon Valley tech to be a growth story. Sometimes, maybe a good cup of coffee and a loyal local customer base is all it takes.
Maybe so. Now, the stock initially dipped because management kept its full-year guidance the same, despite that strong quarter. Cramer views that as responsible, not wanting to get ahead of themselves. But couldn't some investors argue management missed a chance there to boost confidence immediately? What's the risk of being too conservative with guidance right now?
That's a great question. In a market that's really hungry for positive news, holding guidance steady, it can sometimes be perceived as maybe a lack of conviction or perhaps a hint of underlying caution about what's coming next. However, a more conservative approach, it also builds credibility over time. If they later raise guidance, it's often seen as a much stronger signal of sustainable growth. Cramer seems to believe they'll reassess after the next quarter, which is their seasonally largest time of the year, so it suggests a kind of strategic patience.
Okay, so Casey's gives us that micro look at regional growth. But zooming out, the broader U.S. economy, particularly around job growth, well, it's presenting a much more complex and sometimes, frankly, contradictory narrative. Recent reports show U.S. job growth was revised down significantly. The economy added, 911,000 fewer jobs than previously reported for the year before March 2025? That brings the total reduction to around 1.2 million jobs over the past 16 months, according to CNBC. Even J.P. Morgan CEO Jamie Dimon stated bluntly, the economy is weakening.
You're right, the data is quite stark. But what's truly fascinating, almost paradoxical, is the market's reaction. Despite these labor market worries, major U.S. indexes, the S&P 500, Dow Jones, NASDAQ Composite, Albat, they all climbed to close at all-time highs on Tuesday. That's from CNBC and Yahoo Finance.
Right, it doesn't seem to add up.
Exactly. This paradox reveals a powerful truth about modern markets, I think. They're often less about reacting to the present and more about anticipating central bank action. This rally is largely fueled by investor conviction that the Fed will cut interest rates. Traders now see an increased chance of cuts at each of the Fed's next 3 meetings this year. Barclays economists, according to CNBC, Bloomberg, Reuters, expect 3 quarter-point cuts before year-end.
And the big question for everyone is by how much? Bloomberg reported the market's now pricing in at least a 25 basis point cut for the upcoming September 16-17 Fed meeting, with some pretty aggressive positioning and options for maybe even a larger 50 basis point cut. And Treasury yields have already dropped to their lowest levels in about 5 months, reflecting that dovish sentiment. The risk, of course, is that the Fed might not oblige quite as aggressively as the market hopes, right? Setting up a potential clash.
Precisely. That potential market-Fed disconnect is always something critical to watch. And, adding another layer of, political drama to the Fed picture, a federal judge has temporarily blocked President Trump from firing Federal Reserve Governor Lisa Cook. That's reported by Bloomberg and CNBC.
Right, let's just put this in perspective for everyone listening. Trump announced he intended to fire Cook back in August, citing allegations of mortgage fraud from before she joined the Fed. But Judge Gia Cobb ruled this likely didn't constitute cause for dismissal under the Federal Reserve Act, and that the way she was dismissed likely violated her due process rights. The judge specifically emphasized the public interest in Federal Reserve independence. That's a pretty crucial defense of the Fed's autonomy, isn't it?
It absolutely is a very significant ruling. It means Governor Cook can participate in next week's crucial Fed policy meeting where those rate cuts are expected. Now, while the Justice Department has opened a criminal probe into Cook, and the Supreme Court might ultimately have the final say, with the case being fast-tracked for oral arguments in November, This ruling, for now, is a significant win for Fed independence. Had Cook been successfully removed, Trump would have nominated her replacement, potentially giving his nominees a majority on the Fed board, as CNBC pointed out. The implications for policy are, well, considerable.
Okay, now let's broaden our view again to global trade. This gets complicated. President Trump is pushing an aggressive new strategy, urging the European Union to impose 100% tariffs on India and China over their Russian oil purchases, with the U.S. prepared to mirror any such tariffs. This comes from CNBC, Bloomberg, and Yahoo Finance reports.
Yeah, that move, as Bloomberg and CNBC noted, seems explicitly aimed at increasing pressure on Putin, trying to get him to negotiate an end to the war in Ukraine, especially after Trump's deadline for a meeting with Putin and Zelensky passed without any progress. However, this proposal faces significant hurdles. It really challenges the EU's internal dynamics. Some nations, like Hungary, for example, have blocked stringent sanctions against Russia's energy sector before, making a unanimous EU agreement on 100% tariffs seem, well, unlikely.
It's an incredibly complex situation. The U.S. has already imposed a 25% tariff on Indian imports, raising total duties as high as 50% over India's Russian oil buys, which India calls unfair, unjustified, and unreasonable, according to CNBC. Yet at the same time, both Trump and Indian Prime Minister Modi recently voiced optimism about reaching a U.S.-India trade deal. Trump even said he foresees no difficulty in coming to a successful conclusion. That's from CNBC and Bloomberg. And similarly, Trump extended a pause on higher tariffs on Chinese goods into early November, seeking a trade deal with President Xi. It's a lot of mixed messages.
Indeed it is. And looking into the bigger picture here, China's foreign ministry stated that China is not the creator of this crisis, nor is it a party involved. And they firmly oppose using China to make excuses, as reported by Bloomberg. This raises a really critical question about the U.S. calculus here, because new tariffs on China could destabilize critical magnet supplies needed for American manufacturing, and could even jeopardize a potential summit with Xi Jinping, as Bloomberg pointed out. The geopolitical stakes are incredibly high, with potential economic ripple effects felt very broadly.
And we're already seeing the real-world consequences of these trade tensions. A record 47% of U.S. businesses surveyed by the American Chamber of Commerce in Shanghai have diverted investments planned for China over the past year, primarily going to Southeast Asia, then the Indian subcontinent, followed by the U.S. and Mexico. That's according to CNBC.
Right, and the reasons for this shift are, well, multifaceted. Besides the obvious U.S.-China trade tensions and those high tariffs, U.S. tariffs on Chinese goods average around 58%, China's retaliatory ones around 33%. Increasing domestic competition in China is also a significant factor. Chinese competitors are now seen as more advanced in 6 out of 8 categories, particularly in speed to market and, interestingly, adoption of artificial intelligence. That's 41% overall, and a striking 62% in retail and consumer sectors, as the CNBC article detailed.
Although, interestingly, China's regulatory environment for foreign businesses is apparently showing some improvement in transparency and equal treatment. Beijing is actively trying to attract and retain foreign investment. However, that same AmCham Shanghai survey also noted that 14% of respondents still reported a worsening environment, particularly in the tech sector at 31%. So it's definitely a mixed picture on the ground.
And this tariff ripple effect, it extends even further, impacting trade relationships beyond just the main players. U.S. tariffs on Japanese goods, including cars and auto parts, they're set to be lowered by September 16th, following a U.S.-Japan trade deal, according to Yahoo Finance. Conversely, a 20% tariff contributed to a 2% drop in Vietnam's exports to the U.S. in August. And Vietnam also saw a drop in imports from China, partly due to concerns about it being used as a transshipment hub. The petrochemical sector also faces a potential 15% drop in global trade due to U.S. tariffs. It really touches many areas.
And, just to complicate things even further, the Supreme Court is fast-tracking a legal challenge to President Trump's tariffs. Oral arguments are expected in November. That's from CNBC and Yahoo Finance. Treasury Secretary Scott Bessent warned that if these tariffs are overturned, the U.S. could have to refund around $1 trillion in tariff revenue, and Congress would then have to respond accordingly. That's a huge amount of money and a significant legal battle looming. Okay, let's shift gears one last time to evolving frontiers for investors. There's a significant global push happening to expand retail investors' access to private markets. We see this in the UK with their new long-term asset funds, or LTAFs. And in the US, President Trump signed an executive order to increase the availability of alternative assets in retirement plans. That's according to CNBC.
Yeah, this push is really gaining traction. Proponents of greater access, they emphasize several benefits. Things like portfolio diversification, potential for long-term, maybe higher returns beyond public markets, and even a boost to wider economic growth. These evergreen funds, sometimes called semi-liquid or perpetual funds, are emerging as a potential game-changer structure. Offering more flexibility for retail investors, according to CNBC, think of them as a more flexible way to tap into those typically long-term, less liquid private investments. Kind of a middle ground between traditional private equity lockups and easily tradable public stocks. They're designed to give you, the everyday investor, a taste of that private market potential.
That sounds appealing on the surface, and the diversification aspect is certainly attractive. But it makes me wonder, are everyday investors truly equipped for the complexities and, importantly, the risks involved here?
It's an absolutely crucial question to ask. And yes, there are significant concerns. These include the relative risk, a lack of transparency and disclosure requirements compared to public markets, and critically, restricted access to liquidity. That's a big one.
Yeah.
LTAFs, for instance, only offer periodic access to your money, usually with a withdrawal notice period. And they often involve pretty significant fees, as the CNBC article points out.
Right.
Moody's ratings analysts specifically warn of liquidity risks during times of market turbulence or recession fears, where retail investors might just run for the exits, potentially worsening any mismatches between assets and withdrawal demands. They also note growing credit risk in private credit assets amidst things like deglobalization, the energy transition, and AI demands.
And even Morningstar, in its first ever qualitative ratings report on these semi-liquid strategies, found that while these funds have grown massively, over 60% since 2022, their fee structures and limited liquidity make them difficult to evaluate. That underscores the need for independent analysis, according to CNBC. So for you, the key takeaway really seems to be this. While the allure of private markets is strong with these new structures emerging, the need for independent analysis and a deep understanding of those liquidity risks and fee structures is more critical than ever. Don't just follow the trend without doing your homework. Okay, and speaking of new frontiers, let's quickly touch on cryptocurrencies. India is notably leaning against creating a full legislative framework for crypto. Instead, they're opting to maintain just partial oversight. That's reported by Reuters.
Yeah, and this stance, it sparks an interesting discussion. Why the resistance? A government document suggests India fears that granting crypto full legitimacy could cause the sector to become systemic, posing significant risks to their regulated financial system. They also note that even an outright ban can't really tackle peer-to-peer transfers or decentralized exchanges effectively. It's a genuinely complex regulatory dilemma for them.
Which is a really stark contrast to what we're seeing elsewhere, isn't it? The U.S., for instance, saw President Trump sign the Genius Act into law in July, specifically permitting wider use of stablecoins by clarifying their regulatory status. China is reportedly even considering a yuan-backed stablecoin. While Japan and Australia are actively developing regulatory frameworks, Reuters highlighted these points. India really stands out with its caution.
It does. And India's cautious approach seems to acknowledge that widespread U.S. adoption of dollar-backed stablecoins could significantly impact emerging economies. And that requires close examination. There's a definite concern that widespread stablecoin use could fragment national payment systems, like India's own Unified Payment Interface, the UPI, and weaken their digital payments infrastructure. That's from the Reuters document. So currently, global crypto exchanges operate in India after local registration for anti-money laundering checks, and there are punitive taxes on games. But their central bank continues to caution against the inherent risks.
Wow. Okay, so we covered a lot today. What a deep dive. We've navigated the stunning rise of Oracle, really driven by AI, explored the strategic power of share buybacks, analyzed that delicate balance between a weakening jobs market and the market's relentless expectation of Fed rate cuts, and untangled that intricate web of global tariffs and shifting supply chains. Plus, we looked at the evolving and sometimes risky landscape of new investment opportunities for you, from private markets to India's crypto stance.
Absolutely. It really just highlights how interconnected everything is, doesn't it? The surprising resilience of the S&P 500, for instance. It isn't just about company performance in isolation. It's also deeply tied to the anticipation of central bank actions and those ongoing geopolitical machinations. And the global economy is just constantly reacting to political maneuvering, technological innovation, and, well, evolving investor psychology.
Exactly. With so many moving parts, from AI's impact on tech giants like Oracle to the Supreme Court's decisions on trade, and the Fed's next move staying informed isn't just about collecting facts anymore. It's really about understanding the complex relationships between them and knowing which details truly matter to your own financial outlook.
Which, leads us to maybe a provocative thought for you to consider as we wrap up. In a financial world that seems increasingly driven by forward-looking projections and the anticipation of policy shifts, rather than just current performance, How does this redefine what we should prioritize when assessing value and risk in our own investment strategies?
A lot to chew on there. Thank you for joining us on this deep dive. We'll see you all tomorrow morning with new headlines from major financial magazines.